Okay, good morning, everyone. So, welcome to the part two of our discussion of the statement of changes in equity. So, we all know that the statement of changes in equity in part one, we already discussed the forms of business organizations. We have sole proprietorship, partnership, and corporation. So we already tackled about the characteristics of the three forms of business organization. Now, at this moment, we are going to discuss about how are we going to prepare the statement of changes in equity by form of business organization. So what is the statement of changes in equity, by the way? So the statement of changes in equity is prepared to meet the requirements of the readers to understand the transactions that cause the movements in equity accounts. So the statement of changes in equity is a statement dated for the year end. So among the three, the statement of financial position, we have the statement of comprehensive income, and this is the third one, the statement of changes in equity. We have two for the year ended, and take note that statement of financial position is always as of the year ended. Okay, so the report shows a reconciliation of the beginning and ending balances of the equity accounts. Also, it summarizes the equity transactions with the owners of the business that occurred during the year. So as you can see here, this is the objective of the statement of changes in equity. We have the balance as of January 1. We have here the balance as of January 1. Then we have the equity transactions with the owners. And then we have the balance for the year ended December 31. So we have balance of 100,000, and let's just say, for example, the balance, ending balance is 150,000. This is the balance in January 1 is the beginning balance of 100,000. The ending balance of the equity is 150,000. So we have an equity transactions with honors of 50,000 pesos. Okay, so let's proceed to the next slide. So forms of business organization. So among these three, sole proprietorship, partnership, corporation, which is the one, which is the form of business organization that is commonly described in the box. It is the most complex form of business organization. It is owned by many owners called stockholders or shareholders. Ownership is divided into common stocks or shares of stocks. One shareholder can own many stocks. One of its characteristics is the separation of ownership and management, and also shareholders invest their funds but are not normally involved in the day-to-day operations. Rather, the corporation is managed by professional managers. So what is the answer? We have corporation. Next, so this is the preparation of the statement of statement of changes in equity in sole proprietorship. So as you can see, we have here the drawings. When we say drawings, this is the withdrawals, and we have the honors capital. So this is what we call the T account. Okay, so we have debit, credit, no drawings, beginning balance, withdrawal, ending balance, and the closing balance will be reflected in the owner's capital called withdrawals or drawing. So we have beginning balance, contribution, net income, minus withdrawals, and that is the ending balance. Okay, so the owner's capital account tracks the following transaction of the owner. We have the capital contributions, we have the withdrawals, we have the net income or net loss generated by the business. So consider this, the net income generated from the operations of the business is owned by the owner. The capital account represents the part of the business that belongs to the owners. So therefore, the net income that belongs to the owner should be included in his capital account. So in sole proprietorship, we have this statement of changes in equity format. So this is the format of the statement of changes in equity in a sole proprietorship. So we have the heading ABC Company, the statement of changes in equity for the period ended December 31. So we have the owner. This is when we say January 1, this is the beginning balance. Add net income, owner's contribution, plus the owner's drawings or the withdrawals. Then we have the owner's capital or the ending balance. So take note that the ending balance here of the statement of changes in equity reflects in the owner's capital. Okay, dili ni siya mao, wrong ni siya. This should be reflected in the total, the owner's capital. So in the statement of financial position, we have the accounts payable, the notes payable, the total liabilities, the owner's capital, and the total liabilities and owner's equity. So you are just going to add the total liabilities and the owner capital, which you get this from the statement of changes in equity. So this side, conditional side, will be reflected on the liabilities and equity portion of the statement of financial position. Okay, so let's have an example. In a sole proprietorship, we have friendly convenience stores, sole proprietorship. So according to the transaction, Joanna de la Cruz is the owner of the friendly convenience store. The store was established on January 1, 2000. So Joanna deposited 10,000 to a bank account in the name of Friendly Convenience Store. She made 3 more deposits of 2,500 each during the year from her personal account. So the store generated net income of 35,670 in 2000. So Joanna regularly withdraws 1,000 per month from the store's bank account for her personal expenses. So you are going to determine the 2000 year-end balance of Joanna de la Cruz, and second is you're going to prepare a statement of changes in equity for the year ended December 31. So let's proceed. So the answer is in number 1 requirement, the 2000 year-end balance of Joanna de la Cruz is amounting to 12,000. Why? Why is it that it's 12,000? It's because this is computed as 1,000 per month times 12 months. And second, is you are going to prepare the statement of changes in equity for sole proprietorship. Following the format that we have seen earlier, this will be the statement of changes in equity for the sole proprietorship. So don't forget the heading, Friendly Convenience Store, statement of changes in equity for the year ended December 31, 2000. There is no beginning balance because Joanna de la Cruz operated the business this year lang. So when we say beginning balance, just take, for example, this one. So the ending capital balance of Joanna de la Cruz is 41,170. So the result is this is the ending balance. And for the coming year, January 1, 2001, this will be the beginning balance also. So let's go back. There is no beginning balance because this is the first year of the operation of the business. And that's going to add the owner's contribution of 10,000 plus 7,500. Why is it that it's 7,500? Because according to our transaction, that Joanna deposited 3 more deposits of 2,500. So 2,500 times 3 is 7,500. So a total of 17,500. Net income of 36,670 plus drawings of how much is our drawings? 12,000. So we have a total of 41,170. So that is the answer in our example question. Next, we have the partnership. So the second form of business organization is partnership. So each partner's capital account will track his or her contributions to the business, share in the net income, and drawings. So question, how do we determine the amount of the net income that will be close to each partner's capital account when there are several capital accounts in the partnership accounting records? The answer, accountants can call this process allocation of net income. So net income is allocated based on the profit and loss sharing agreement stipulated in the partnership contract. So allocation of the net income is unique only to partnership. Again, in the part 1, I already tackled about it, the importance of the contract. There should be a sharing agreement stipulated in the partnership contract. Okay, so this is the format of the partnership statement of changes in equity. So as you can see, it is different from the sole proprietorship. Why? Because we have now here the partner capital. So partner A, partner B, partner C, let's just say, for example, partner D, partner E, depends upon. So every partner is reflected in the statement of changes in equity. And it is still the same. We have the balance, add net income, partner's contribution, the honors, the balance, and in the liabilities and honors equity portion of the balance sheet, this will be the result. So instead of honors capital, there should be partner A capital, partner B capital, partner C capital. So partner A, the ending balance capital of partner A will be reflected here. Partner B will be reflected, still will be reflected here in the statement of financial position. So let's have an example. In the partnership, the DEF partnership, it established in 2000. So the partners Diana, Amanda, and Fanny have January 1, 2000 outstanding capital balances of 25,600, 43,800, 37,655 respectively. So Diana contributed 15,000 during 2001. And Mena and Fanny also contributed 10,000 each in 2001. So the 2001 year-end balance of each partner's drawings account are as follows. So naka-withdraw sila of 12, 15, and 14,000. So the partnership reported 2001 net income of 75,650. So according to the partnership agreement, the partners' profit sharing ratio is 30%, 40%, and 30% for Diana, Mena, and Fanny. So you are required to prepare the 2001 statement of comprehensive statement of changes in equity of DEF partnership. So the answer is this one. Still following the format, we have DEF Partnership Statement of Changes in Equity for the year ended December 31. So as you can see, we have the balance of a beginning balance of 25, 43, and 37 as stipulated in the transaction itself. We are going to add the partner's contribution of 15, 10, and 10 because this is also given in the transaction. And we are also going to add the net income. How did we get the net income of 22, 30, and 22? It is based on the partners shares agreement. So we have the partners agreement, we have 30%, 40%, and 30%. So the total net income is 75,650 times 30%. This will be the result, 22,695. MENA times 75,650 times 40%. This will be the result, 32,260. And the same as FUNI, 22,695. Less the drawings or the withdrawal of each partners, then they have the balance on December 31, ending balance of capital on December 31. Now, let's proceed to corporation. Corporation, we have paid in capital and we have retained earnings. So this is the format. This is the T account of capital stock, additional paid in capital, and retained earnings. So the total proceeds from issuance of stocks during the year is this one. This is par value of stocks issued and issue price par times issued stocks. So this is the total proceeds from issuance of stocks during the year. So this is the T account of capital stocks. Now, the format of the statement of changes in equity, we have ABC Incorporated statement of changes in equity for the period ended December 31. So we have here, instead of partners diri ang nakabutang, we have capital stock, additional paid in capital, retained earnings. So we have balance and beginning balance as of January 1. We are going to add net income and issuance of new stocks. And also, we are going to less the dividends and balance of December 31, 2001. So in the liabilities and stockholders' equity, the portion balance of the statement of financial position, we have, as you can see, we have accounts payable, accrued expenses, notes payable, and this the total liabilities. And instead of the name of the partners in the equity portion of the statement of financial position, we have the capital stock, we have the additional paid in capital, and we also have the retained earnings. So the total capital stock will reflect on the statement of financial position and the equity portion, the same as the additional paid in capital and the retained earnings. So let's proceed to the example in the corporation. In our transaction, GHI Incorporated was established in 2000. The corporation issued 10,010 pesos par value shares of stock and at an issue price of 20 pesos per share. On July 15, 2001, the corporation issued 1,000 new shares at an issue price of 25 per share. The corporation reported net income of 56,785 and 65,870 in 2000 and 2001, respectively. So dividends of 2.15 pesos per share were declared and distributed to shareholders on February 1, 2001. So there were no dividends distributed on the first year of operations of the corporation. So you are required to prepare the 2001 statement of changes in equity of GHI Incorporated. So the answer here, Again, we have the heading GHI Corporation Statement of Changes in Equity for the year ended December 31, 2001. So we have the capital stock, additional paid in, retained earnings, and total. Beginning balance as of January 1, 2001. We have 100,000 capital stock. We also have 100,000 paid in capital, and we also have retained earnings of 56,785. Ama na to ni nakuha si 56,708. It is the reported net income. So this is retained earnings because this is a reported net income on last year 2001. And as you can see, we have the net income at the moment of the year 65,870. Where did we get the additional paid in capital? Issued par value of stocks. So we have 10,000 times 10 pesos par value. That is the shares of stock of 100,000. That is capital stock. Then we have the corporation issued 1,000 new shares at an issue price of 25 per share. And we have dividends. Our dividends is 21,500. So respectively, dividends is 2.15 per share. So we are just going to multiply this one. So we have the dividends here. We are going to deduct that one. So we have the ending balance as of December 31, 2001. So this is the computation of how did we get the capital stock, the additional paid in capital, and also the additional paid in capital issuance of 15,000. And then asasad na to nakuha si dividends for 2001. So that's the end of our discussion. If you have questions regarding our discussion, especially in the computation, don't hesitate to ask me. So I hope that you already received your module. So thank you so much and God bless.